Did you know that the Fed's actions might be tipping the global economy towards a sovereign debt crisis? Welcome to Financial Insights in Minutes, where we deliver time-saving financial summaries you need to hear. In today's rapidly changing economic landscape, staying informed about these pivotal shifts is essential.
Expect debates about the future of silver, warnings on stock market crashes, and emerging trends in the banking sector.
Let's dive into our content for the day, starting with vital insights from impactful financial experts.
Today, we'll summarize 6 critical videos capturing the pulse of our financial world today.
First up, Edward Dowd warns of a global sovereign debt crisis triggered by recent Fed policies. Next, we analyze critical market signals as the S&P 500 shows signs of a potential recession. Following that, Lance Roberts questions whether the stock market has hit its bottom yet amidst current market trends. Shawn Khunkhun highlights alarming signs in the silver market, pegging prices to potentially surge to $73. Chris Giavacco explores whether economic conditions will open a door for bears or signal a surprising stock rally. Finally, Jack Farley debates recession versus rebound, examining critical employment metrics and their implications. Welcome to Kitco News. Today, we explore the potential for a global sovereign debt crisis and the recent alarms from Japan's financial mishaps.
Exactly. Edward Dowd, with his rich experience, sheds light on the current economic frailties, particularly concerning the Federal Reserve's impact on global markets.
So what's the central thesis of Edward's discussion?
The core message is clear. The Fed's monetary policy may have disrupted the Bank of Japan, triggering risks of a widespread debt unwind amid declining economic indicators.
What are those economic indicators saying?
They have shown consistent decline since March, signaling trouble ahead for the global economy.
And what triggered Japan's recent currency issues?
The Fed's aggressive rate hikes caused the yen to plummet, pushing Japan's economy into a tight corner.
Now, about the banks, what's Edward predicting?
He foresees a consolidation in the banking industry, eventually landing with 6 to 8 dominant banks.
What about global tensions? How do they factor in?
With tensions mounting in places like Taiwan and the Middle East, geopolitical unrest could further escalate financial instability.
What's the situation with the Federal Reserve?
They're walking a tightrope, unwilling to cut rates too soon, which could signal deeper issues.
So looking ahead, what's on the horizon?
Expect financial upheaval with distinct signs of a looming crisis in the next couple of years.
And what about the banking landscape?
The number of significant banks in the U.S. could dwindle significantly, a major shakeup by 2025.
In summary, what are the critical takeaways from Edward's insights?
The need for urgent and strategic economic policies is paramount to stave off potential crises in the near future.
Welcome everyone to an exciting episode from Game of Trades. Today's hot topic, the S&P 500 has broken down in a big way. What does that mean for the market?
Absolutely. This isn't just another blip on the radar. We're diving into the implications of steepening yield curves and what's looming ahead for traders and investors alike.
So, what's the core thesis behind this breakdown? What's the heart of the matter?
The core message is clear. The S&P 500's significant dip and steepening yield curve suggests that financial markets are pricing in a potential recession. It's a serious heads-up for traders.
Now, what about those market valuations? What's the outlook?
The S&P 500 could see a decline of 40 to 50% due to incredibly elevated market valuations. We're looking at a price-to-earnings ratio still above 30, higher than in 1929.
And how does the yield curve fit into this?
Great question. A steepening yield curve is a traditional signal heading into economic downturns. It's a sign that the markets are worried.
What about the recent volatility? What's the deal?
Well, spikes in the VIX, especially above 30, usually indicate impending market bottoms. The Federal Reserve tends to cut rates after such spikes, helping stabilize markets.
What are the key predictions surrounding these market conditions?
The Fed's intervention could bring brief relief, but if we enter a recession, long-term declines may follow any initial rallies.
What's the timeline looking like?
Exactly. If a recession happens quickly, the market could react negatively, but if the Fed stabilizes without immediate recession worries, we might see gains.
To wrap it up, what are the main takeaways?
Caution is essential. As indicators point to potential downturns, Investors should strategize their approach and stay alert in these turbulent waters.
Welcome back to Thoughtful Money. Today, we're diving deep into the stock market performance with our esteemed financial analyst, Lance Roberts. What's trending lately?
Absolutely. Today's discussion centers around the recent market rally and ongoing stock trends. With Lance's expertise, we're set for an insightful dive.
So, what's the team's main thesis for the market right now?
Currently, it's unlikely stocks have hit their bottom just yet. Market participants should remain cautious and use recent rallies to rebalance risk and manage exposure.
What are the key points regarding the current market conditions?
Lance notes that the ongoing rally is influenced by the unwinding of the carry trade, while investor sentiment continues to lean bullish.
Interesting. What's happening with interest rates?
Yes, anticipation around interest rate hikes from Japan has caused significant market volatility, especially in U.S. markets.
And what about the overall global economic health?
Economists are cautious about recession signs, but predict a delay, indicating growth is still present for now.
What's the ideal investment strategy moving forward?
Investors should consider using rebounds to rebalance their portfolios. Solid long-term investments remain the way to go.
What predictions can Lance share regarding market movements?
Volatility is expected to remain until at least October. Global economic shifts, particularly in interest rates, will keep markets on edge.
Are there any expected changes in investor sentiment?
Yes, if negative conditions persist, a bearish shift in sentiment among investors could lead to more significant sell-offs.
To wrap things up, what's the crucial takeaway for viewers?
The focus should be on maintaining cautious strategies amidst market uncertainties. Using the current rally wisely can help in managing overall risk.
Final thoughts for investors?
Absolutely. Keeping a keen eye on market conditions will be essential to making informed investment decisions.
Welcome back to David Lin's channel. Today we're diving deep into the alarming signs of what Shawn Khunkhun calls financial Armageddon for silver markets, with a $73 target looming on the horizon. Get ready for some eye-opening insights.
That's right. Shawn has an extensive background in silver investments and market analysis, making him a credible voice in our discussion today. It's about to get serious.
Let's kick things off. What is the core message from Shawn's analysis?
Shawn's thesis indicates a worrying trend. The silver market is signaling depletion, which is likely to result in skyrocketing prices, possibly reaching $73. It's drastic.
All right, let's break down those important trends in the silver market.
Certainly. As Shawn highlights, demand for silver is booming across sectors like technology and renewable energy, but suppliers are struggling to keep up, creating a tense situation.
What's the scoop on depletion in silver supplies?
Shawn mentions that depleting existing mines is a critical concern, and unfortunately, new discoveries aren't filling that void effectively.
Investing in silver seems to be a hot topic, right?
Absolutely. Shawn urges investors to consider silver as a hedge against economic turmoil and inflation, which is very attractive given current market conditions.
What are Shawn's predictions about silver prices?
He forecasts an urgent surge in silver prices to $73. If demand continues outpacing supply, we could see some serious volatility in the market.
And what about the broader economic impact?
Well, high volatility in silver could ripple through stocks and commodities, possibly prompting a rush of investors back into the silver market.
So, what are the big takeaways here?
In a nutshell, observant investors should brace for a significant price surge in silver due to depletion signals. Being proactive in this market might just pay off.
Any final words on the investment angle?
Absolutely. Given the current economic conditions, the case for silver as an investment has never been stronger. Let's keep our eyes on that $73 target.
Welcome to CiovaccoCapital's latest update. Today, we're tackling a burning question. Are we seeing an opening for the bears, or is a shocking stock rally on the horizon?
It's time to get straight to the facts. Chris Ciovacco dives deep into the charts and data to bring us the latest insights on market performance and trends.
So, what's the central idea that Chris tackles in this video?
The core thesis is that following rapid Fed rate cuts, historical trends suggest that if recession fears are absent, the stock market typically rallies significantly.
Let's dissect those key points, starting with the Fed rate cuts. What's the bottom line?
Historically, rapid Fed cuts usually signal an economic problem, but slow cuts show a healthier market, with the S&P 500 appreciating over time.
And what do the stats say about market performance?
In cases of slow cuts, the S&P typically rises about 20% in 1 year, while the Nasdaq averages 50% gains.
What about the job market? How's it reacting?
The non-farm payroll report missed expectations, causing some market turmoil. However, underlying employment metrics weren't as bad as they seemed.
Any recent trends we should be watching?
Absolutely, a sudden market drop raised some alarms, and the VIX has been spiking, indicating heightened market anxiety.
Looking ahead, what does Chris predict?
He anticipates potential Fed action in the coming months, but remains optimistic about a long-term market uptrend.
So, any predictions for the market's future?
Yes, if conditions remain steady, there's potential for a market rally as recession fears ease.
What should viewers brace for in terms of volatility?
Buckle up. Mixed signals from economic reports could lead to more fluctuations in stock prices.
To wrap it up, what are Chris's key takeaways for investors?
Investors should remain cautious yet optimistic, watching the Fed's moves and maintaining flexibility in their strategies.
Welcome back to Blockworks Macro. Today, we're diving into the heated debate surrounding the economy. Are we heading for a recession or a rebound? Our guest today is Jack Farley, an economics expert and the informative host of the Blockworks Macro Show.
Absolutely. Buckle up as we navigate through the nuances of this captivating economic landscape, dissecting key data points and market movements.
What's the core thesis we're wrestling with here?
The crux is that while current employment reports show job gains, the contraction in the coincident employment index hints at a potential recession looming in our near future.
Let's break down the job growth indicators. What's the latest scoop?
Despite adding jobs, we're witnessing an increase in the unemployment rate, which could signal turbulence ahead.
What's going on in the markets?
Recent volatility has raised eyebrows, with substantial liquidations in both equities and crypto, leading many to adjust their positions aggressively.
And about predictions for the economy.
We're anticipating rate cuts as growth remains sluggish, but central banks are on high alert to manage market reactions.
What are some predictions regarding the economic landscape?
The data indicates that a continued decline in employment metrics may lead to layoffs, signaling a deeper economic slowdown.
And what about opportunities in the market?
If rates are cut, we may see a positive response in tech stocks, presenting lucrative opportunities for savvy investors.
So as we wrap up today, what key conclusions can we draw?
Ultimately, current economic indicators suggest a precarious landscape. Investors should remain vigilant and adaptable as conditions evolve.
Any final thoughts on what to keep an eye on?
Absolutely. All eyes should be on the upcoming employment reports, as they will be crucial in determining the direction for the economy.
Today, we explored crucial arguments about the Fed's influence leading to potential economic turmoil and stock market instability.
While some guests emphasized the dire warnings of a potential recession, others see signs of a rebound in select sectors.
Ultimately, the consensus underscores the necessity of strategic engagement with these evolving financial narratives. Thanks for watching Financial Insights in Minutes for August 10th, 2024. If you'd like more time-saving content, please remember to like and subscribe. If you have ideas for more channels you'd like to see summarized, drop a comment below. See you next time.